everyone. A warm welcome to yet another session of our Bespoke series by Vendes Wealth. For those joining us for the first time, Bespoke is an initiative by Vendes Wealth designed to engage with our client on topics that are more relevant and meaningful. I'm Faima Sheikh from the product team at Vendes. Today we mark 5th edition of this series, and we are excited to deep dive into specialized investment funds (SIF), a unique investment vehicle offering opportunity across equity, debt, and hybrid. Today's session will focus more on the understanding what sets SIF apart. It's a new investment vehicle. Everyone should know about it. Let me introduce to our expert panel today. Shravan Srivastava, Head of Public Market and Investment Solution Group at Vendes Wealth. Nandik Malik, Head of Equity and Hybrid for proposed SIF at Axis Mutual Fund. Mansi Sajeja, Senior Fund Manager Fixed Income at SBI Mutual Fund. And Niranjan Avasthi, Head of Product Marketing and Digital at Edelweiss Mutual Fund. We'll take questions during our Q&A session towards the end. Please type them in the chat box bottom of your screen and feel free to address them to any panelist. With that, I'll hand it over to Shravan to give an overview on SIF. Yeah, over to you, Shravan.
Thank you. Thank you, Faima. I think we're all very excited to have this session. I think very few times where you get a lot of demand for such events and sessions, and that's the reason why we said it might be very topical to curate this particular piece. If that presentation can come up, we can go through a few slides before we go ahead. So basically, SIF is nothing but a special investment vehicle. I think after the AIF idea, which I think SEBI has proposed and executed since 2013, we have seen that the next big idea is the SIF vehicle introduction that we have seen. If you look at the success of AIFs, it's been tremendous. I think currently we have about 5 lakh crores in the AIFs, out of which about 30% of them is managed in the listed equities space. Prior to that, it was in mid 1990s where we have seen the introduction of mutual funds and PMSs that has come about. If you look at the size of PMSs today is about 5 lakh crores. The size of mutual fund industry has been stupendous at around 70 lakh crores. We think that this idea has a similar potential as what we have seen in some of these vehicles. So just to give a landscape of what the SIFs is all about, I think SEBI has come up with this idea, and I mean it's quite it's quite heartening to see that from our ideation stage, which was in the month of June, I think within less than 9 months it was able to see the light of the day under execution. So June was when it got proposed, the discussion got done, the consultation paper got written, Gazette was issued in the next few months, and finally the final guidelines got through in the month of February, and it's going to get implemented from the 1st of April onwards. So if you go to the next slide, Fahima, I think there's a comparison between SIFs and the other vehicles. So SIF is actually here to fulfill the gap between the mutual fund and PMS. That's where the minimum ticket size is kept as 10 lakh rupees. So SEBI felt that there is a retail portion where you can have a minimum investment of 100 rupees that can come. And there is PMS where the starting point is 50 lakhs. Then there is AI, which is a crore plus. Why don't we have somewhere in between where I think the risk return metrics can be much more I think expressed through the fund managers. And that's why this 10 lakh number has come about. When you look at the investor category, that's the reason why it's been called out as non-retail. Most of the non-retail participants go and participate in mutual funds for sure. The non-retail goes and participates in PMS and AIFs as well. And there is small ticket non-retail. I think that's where the SIFs come into picture. In terms of the taxation, since it is under the mutual fund umbrella, the taxation is like the mutual funds where the long-term capital gains is at 2.5% after 12 months. The fixed income products will have a taxation which is again similar to the mutual funds, which is at marginal rate. And the other opportunities will be at LTCG 2.5% after 2 years. On the other hand, PMSs are taxed at each transaction level of the investor, and AIFs are not taxed when you redeem because it is taxed at the platform level. Whenever the fund is doing investments, it is taxed as short-term capital gains or long-term capital gains, depending on the period of holding and business income for any other fixed income investments that they hold. In terms of leverage, like mutual funds, SIFs are not allowed to have any leverage. So if the gross exposure is 100 rupees allowed, it is only at 100 rupees. The PMS also has that particular limit. It's AIFs which can go up to 2x of the limit. So they can go up to gross exposure of 200%. In case of derivatives, I think that's where the differentiation comes with SIFs, wherein 25% of the corpus can be used for unhedged portfolios. So far, it's only being used as for hedging, both in mutual funds as well as for PMSs. The hedging was allowed for both these vehicles, and AIFs were allowed to take up to 2x exposure. But whereas in case of SIFs, now it's been introduced as a starting point is 25% of unhedged exposure. So I think it's a great vehicle which is coming in between the mutual fund and PMS platform. I think it's going to be widely accepted. It's not only specific to let's say larger retail or lesser HNI kind of a thing. I think it's going to be accepted by both HNI, ultra HNIs, treasuries, etc., depending on the opportunities that can come about. Now, what are the opportunities that could be available? I think there are 7 opportunities which has been highlighted in the guidelines. There are 3 equity opportunities, 2 fixed income opportunities, and 2 hybrid activities, hybrid opportunities. Now, I think Nandik, Mansi, and Niranjan will speak more about what these kind of opportunities are. So at the cost of repetition, I would like to skip over it, and I would wait to hear from them as to what opportunities and what exactly the funds can curate in terms of having a better risk-adjusted return to the investors. Now, if you look at the kind of construct of the fund, it can have a gross exposure of 100. If you just go to the next slide, the 100 can come from long only positions. The illustration which is given, illustration 1 is having investment in long only positions is 65. If you have some cash holding, that's 10 rupees, and unhedged positions, which is about 25. So you can have 75 rupees, which is in long only positions, including cash, and 25 rupees, which can be a short position, let's say in a set of securities, in equities or debt or commodities. That adds up to the number of 100 rupees, right? So that's how the 100 is broken up. But if you look at both hedged as well as unhedged, so within that 65, there can be 65 long only positions, but there can be 5% of the portfolio which can be having a hedge position. It can be a long stock, short future kind of a thing, or any other hedging mechanism using options that you could do, which becomes 5. So it becomes part of the portfolio, and unhedged remains as 25. So the portfolio can be a combination of unhedged position being 0, being 25, and arbitrage position being 0, takes it to 100. But there can be an arbitrage position which gets added up to the long only positions, and unhedged position being capped at 25. So there can be a combination of both that we can potentially see going forward. If you move to the next slide, we will look at what are the instrument level exposures that is permitted. A single company exposure is to the extent of 10% of NAV, which is the current limitation that the mutual funds also have, which is 10% of NAV that's been retained. In case of fixed income, there is some flexibility which is being given. The single issuer AAA, cannot be more than 20%. If it's AA, it cannot be more than 16%. If it is A, it cannot be more than 12%. And these numbers are double than that of the current exposures that the mutual funds have. In case of single sector, it is, there's a flexibility given to 25% of the corpus to a single sector, which is slightly above the current limitation of 20% that the mutual funds have. So certainly there is a lot of flexibility which is given towards the fixed income side of the portfolio compared to the equity side of the portfolio. And if these are breached by about 5% or so, that can be done, but with the approval of the trustees and board, right? So the flexibility that the managers have in fixed income is quite superior to that of mutual fund. Having said that, the flexibility which comes for shorting the portfolio to the extent of 25% also gives a lot of strategies that could be played out within the portfolio. If you just go to the next slide, Faima. So, in a nutshell, I think it's a great vehicle that has been implemented. I think it definitely shows the regulatory dynamism in implementing the idea. Like I said, the ideation started, in June, July of last year and implemented by Feb, March of this year, which is a superb speed at which the regulator has acted upon. And this idea can actually be implemented at scale. I think choice of mutual fund platform is also a good idea. It gives a lot of, I think, comfort to the early adopters of this particular vehicle. And we think that there can be a lot of, I think, risk-adjusted return opportunities that can be seen across asset classes using the, this SIF, vehicle. I think a lot of talent which is available in the country, which can operate in the long short space, will be utilized, much more than what is getting utilized in the AI platform. I think that is something which is heartening to note. And I think this is just a starting point. There are 7 opportunities that the regulator has laid out as a starting point. I think going forward, we would actually see more of it. So very hopeful that this particular segment is going to be a very big one, and glad to participate in it as both investor as well as an advisor distributor in this particular thing. Over to you, Faima.
Thanks, Shravan. Now I'll hand it over to Nandik to give us some insight on the opportunity in equity SIF. Over to you, Nandik.
Thank you, Saima. It's always a pleasure interacting with you. And I have 2 other colleagues with me. I'll be able to see you also for in this call.
Nandik, your voice is not very clear.
Yes, is the voice better now?
Yeah, better.
So thank you, Shravan. Thank you, Faima, for organizing this. I fully agree with Shravan when he says that this category is something which can get big in near future. My personal view, and a lot of it is shared by Access also, is that a lot of the hybrid funds that you see under the MF platform will be under severe pressure. And when I say hybrid funds, I mean from the balanced advantage funds to the equity saving funds. So these kind of funds which are not 100% equity, a lot of them will be under severe pressure because what SIF allows is comparing mutual funds. So we have the first slide which kind of tells that it allows a lot more scientific hedging. So if you look at what we have done in the first slide, we are saying that specialized investment funds feature-wise are a superset of mutual funds. Why do we say that? Because mutual funds offer daily liquidity. Like Shravan rightly said, investors have a lot of confidence with mutual fund products. There is higher compliance. Taxation is either equity or debt. We have kept it equity taxation because most of the funds are either equity or hybrid. And you have defined management fee. You don't have performance fee or any other kind of those kind of features which some other categories have. One point on which people have been asking questions is the taxation part. That taxation doesn't come under SEBI, it comes under CBDT or the income tax part. Fully agree with that point. But if the participants may remember, before SEBI came up with this thing, there was a gazette which was issued by the central government. Now, gazettes are fairly serious documents, and in the gazette, it is mentioned that specialized investment funds will be treated as a mutual fund. So, by extension of that, the rules which apply for mutual funds with respect to, let's say, taxation also will flow into SIS. That is what the initial understanding is. Because now, if they want to give a different tax status to SIS, then they have to change the. There was some regulation which came from Parliament. Some mutual fund taxation rules have to be changed because this has come in Gazette. So that's why the view is that taxation will be similar to mutual funds. So if you're allowing more hedging to happen, more scientific, more sophisticated hedging to happen, under, let's say, with similar features to what mutual fund has, and possibly some additional features, then from our perspective, it's a win-win situation. Now, question comes as to why SEBI allowed this. My sense is SEBI would have allowed this because the volumes in derivatives markets are huge. So if you look at the volumes which happen, it's a $1-2 trillion notional which gets traded on a daily basis. Now, mutual funds have some regulations, they have some limitations. For example, mutual fund may not sell, let's say, stock or index level puts. Now, that debars them from participating in a large proportion of the market. Not many mutual funds sell index level calls also. So covered call selling is allowed, but mainly at stock level. So you will have equity saving schemes, you will have balanced advantage funds of many houses which do covered call selling. What is covered call selling? You have Reliance in the portfolio, for example. You go and sell Reliance call against it. So that is allowed by SEBI, but even in mutual funds, you can't do it more than 15% of the stock holdings that you have. Whereas in the specialized investment funds, let's say in a 100 crore portfolio, you have 70 crores in stocks. You can do that possibly on the entire 70. So that is the leeway which the regulator has given to SIFs. You can have unhedged shorts. What do unhedged shorts mean? Let's say you have a portfolio in which you don't have ICICI Bank. So let's say you have a long portfolio, you have all stocks, but let's say you don't have, let's say, ICICI Bank. So mutual funds cannot short ICICI Bank, so or ICICI Bank futures if they don't have that underlying in the portfolio. So, for example, what arbitrage funds do is they have stocks and they sell futures against it. Now, an arbitrage fund cannot sell an index future that they do not have in the portfolio, whereas SIF, specialized investment funds, can. So, a lot of leeway has been given. SEBI has kept the exposure at 100%, which is a good thing because that way some kind of guardrails have been set in. But all in all, the way in which Access as a AMC sees this, and I as a fund manager see this, is the opportunity opens up to give better risk-adjusted returns. I cannot think of a single mutual fund hybrid category in which the returns cannot be improved using this scheme. And like I said, taxation should tend towards mutual fund taxation because mutual fund taxation is something which has been legislated by the parliament, and any changes which has to come to that has to come through some kind of a parliament change. It is, I think, one level above CBDT. So that is why, from a taxation perspective, also it's a very clear structure which SIFs will bring in for investors. So that is the what the first slide says, broadly summarizing everything what we wanted to say from a operational slash feature perspective. What are the kind of offsets that are allowed? That I think is also very important. So the next few slides that we have covered that. So if you look at the next slide, for example, we have given 8 instances of offsets that get allowed under SIFs. So the first is if you have stock in the portfolio and then you short futures against it. The third column that you're seeing will say what is the equivalent kind of offsetting which is allowed in existing MFs. So the first kind of offset that we talk about is stocks and futures short. It's like arbitrage funds. So let's say you have 10 crores of any stock and you sell 7 crores of futures against it. Then the exposure which gets counted in MF is 10 crores. In SIFs also, the exposure which will get counted is 10 crores. In mutual fund, if you have 10 crores of stocks, you can sell maximum 10 crores of stock. In SIFs, you can sell more than 10 crores. The only thing is the exposure will then be more. So if you have 10 crores of stocks and if you sell, let's say, 12 crores of stock futures, then the last column that you're seeing, the exposure will be 12 crores and not 10 crores. So that talks about the first row that we have here. Second one is what funds do in covered calls. So you may be having stocks against it and you sell the corresponding calls. Then the exposure is so if you have got, let's say, again 10 crores of stocks and you sell, let's say, 8 crores of the calls of the stock, then the exposure remains at 10. If you have 10 crores of stock in mutual funds, you cannot sell, let's say, 11 crores of that stocks calls. Whereas in SIFs, you can sell 11 crores of that stocks calls, but the exposure will then become 11. The exposure will then not be 10. Uh, Third is again futures and calls short, which is similar to stocks and calls short because stocks and futures have got similar alignment. So again, the exposure is similar. The fourth example and the fourth offset which SEBI has allowed is a simple protective put. So if you have stocks and you're buying puts against it, then the exposure because of the buy puts will not be counted. Whereas in mutual fund, let's say if you have got 10 crores of a stock and you buy, let's say, 8 crore of put, then the exposure is 10 crores of the stock plus whatever premium which you are paying for the 8 crores of puts. In mutual funds, when you buy options, the premium of the options gets factored in the calculation. They do not allow any offsetting. So these are the four examples from the first slide. The next four examples are so you have the next slide. You will have another four examples. So yeah, the so if you go to the next slide, you will see that there are four other examples. Okay. Yes. So this slide talks about another four instances. So let's say you have bought futures long and you have bought puts. Then again, it is similar to buying a stock and buying a put. If you have bought calls and if you have sold futures, so let's say you have bought 10 crores of calls and you have sold 15 crores of futures, then the exposure is on 15 and not on 10. The reason is 15 is more than 10, A. Secondly, futures has a one-to-one correlation with how the underlying moves. Whereas in call, if you're buying calls, the loss is limited to the premium which you pay in the portfolio. So in the example given, instead of 10 crores of, let's say, calls and 15 crores of futures, if the example would have been 20 crores of calls and 15 crores of futures, then also the exposure would have been 15. Now, you may ask why 20 did not get counted, why 15 got counted is because 15 is in futures and futures has a linear 1:1 correspondence. So that's why. And the last two examples again are short puts. Short puts typically will be like a long position. Against that, if you are selling futures, then again the exposure is 12 because 12 is more than 8. And the last one, when you're buying calls and when you are selling calls, this example actually I covered before. So the exposure will be 10, not 15, because the calls sold is deemed to be more risky than the calls and the options bought. So we thought it was interesting and it was important to explain how the offsets are allowed because in mutual fund only the first two offsets are allowed, which is stock vis-a-vis stock futures, which arbitrage funds do, and many non-arbitrage funds also do as part of arbitrage. And the second one is covered calls. In mutual funds, only the first two is allowed. Stocks versus futures, they allow for the entire portfolio. Stocks versus covered calls, they allow only for 15% of the stocks you hold in the portfolio. The other six examples that we gave you, that is not allowed in mutual funds, which is allowed in SIFs. So huge amount of scientific hedging is allowed, which will give investors a better risk return profile. And if you go to the next slide, we have given some example as to how the exposure gets calculated, and this is the last slide that we have. So we have given two examples. First example is what is allowed in the portfolio. So let's say it's a 1,000 crore portfolio. You have investment in equity, which would be stocks, is around 700 crores. Let's say out of the 700 crores, 250 is in covered calls. Then the exposure is not 700 plus 250. The exposure remains 700 because that 250 is already counted and offset. After that, you have unhedged calls sold to the tune of 150 crores, which will get counted because it doesn't have a like-to-like correspondence. What I mean by that is, let's say you have Vedanta calls sold in the portfolio, and you don't have Vedanta as the underlying, then that exposure will get counted. So if you look at only the first three rows, the exposure is 750 plus 150. The 250 will not get counted because it is covered call and it gets offset with the stocks that you have in the portfolio. Similarly, you can have futures also sold in the portfolio. And if the futures are hedged, which means you have those stocks in the portfolio, then the exposure will not get counted. So the hedged futures sold to the tune of 100 crores doesn't get counted. The unhedged futures sold in the portfolio will get counted. So therefore, in this portfolio, the exposure that you have is 700 plus 150 in terms of unhedged call solds, which is 850, plus another 50 crores of unhedged futures sold, which is 900 crores. The hedged futures sold and the covered calls that you have sold will not get added in the exposure because that offsetting is allowed. So therefore, in the first portfolio example that we have given, the exposure is 900 crores. Cash that you have in the portfolio will not get counted. If you have debt in the portfolio, that will get counted. But if you have T-bills or government securities which are less than 90 days, then they are deemed as cash or cash equivalent. So this is one example which we thought your participants would find interesting. Similarly, we have given one example of what is not allowed. So again, you have 700 crores of stocks. let's say the covered call component is only 50 crores and the unhedged call component is 200 crores. Then what happens is straight away from the first 3 year exposure becomes 700 plus 200. The 50 doesn't get added, but 700 plus 200 becomes 900. Then if you have hedged futures were 25 crores sold, then that doesn't get added. But then on top of that, you have 900 plus, 125 more. So then it becomes more than 100%. So you have more than 100 crores exposure. So 700 crores will get added to 200 crores, get added to 125. So the exposure which you will then have will be 1025 crores on a base of 1000 crores. Now, someone may say, with a sum of 1,000 crores, can you actually take positions worth a higher amount? Yes, it is possible, because in stocks you have to give the entire money upfront. But when you take positions in options or when you take position in futures, it works on the principle of margin. So even with, let's say, 20 crores of margin money, you can take position in futures, which is equivalent to a 40 crore position. So that's why, someone may actually replicate this example too with 1,000 crores of AUM, but in the calculation, it will show that the exposure is more than 100%, 102.5%. So this will not get allowed. So I think I'll take a pause here. Thank you, Avendus Wealth, for arranging this. Happy to take any further questions afterwards if you have.
Thanks, Nandik. Thank you. Let me remind our participant to start posting the question in the chat box. I'll now hand it over to Mansi to tell us about the opportunities in fixed income. Over to you, Mansi.
Hi. Hi. So, it's an informative session for me as well, because it's a new product which has come up after a long gap. There was a big gap between the retail portfolios that have come up in the mutual funds. The folios have now crossed it's touching 5.5 crore. And all those are very standard products, and now they've become very well accepted. Now, in fixed income, as we understand, the retail participation is still low, and people are looking at strategies where they can diversify as part of their own asset allocation goals, but at the same time have an experience which is regulated and not which is not opaque, and where the portfolios are as open and as discussed as we do for mutual funds. So what are the key changes? If you could go to the next slide. What are we doing here is we are just saying that you have a fixed income, you may have a fixed income fund, which is slightly more flexible, because it is allowing you to take, as we saw in the opening slides, a little more concentrated call in terms of issuers and in terms of the sector. There is a high minimum investment threshold, because it should not be taken as money, which is also, and the big part about fixed income is that all the fixed income strategies are T+1 redemption driven. And in this, at least a weekly redemption is allowed. So it should not be taken as it is going to be a T+1 redemption, but at least 1 week redemption can be allowed here. And there can be slightly more tailored strategies around duration and ratings, which are not like the mutual fund schemes, which has a lot of other institutional investors also. So there are two strategies here which have come in the circular. One is a debt long short product, and one is a kind of a sector long short product. See, they are going to be the product filings are yet to come up. So in fixed income, we are not very sure that what would be the as Nandik was talking about, what would be the derivatives or offsets which are going to be there, or whether they are needed at all, in terms of because the market in India is only developed to the extent of certain interest rate swaps, and not much around this. So the two strategies are going to be, say, debt long short fund. You can invest across duration. You can have some unhedged short exposure, that 25%, which is running across various strategies. And because it's an interval investment strategy, investing in debt instruments, you are allowed to have weekly redemption and not a T+1 or a daily redemption frequency. In the sector long short fund, I mean, it's good to have a sector fund in which you can invest maximum in 75% in a single sector. However, the short part of it, we are still debating that whether there would be any opportunity to short a sector in fixed income. But maybe the market evolves around this category also, and you may have something similar. As for equity, you may have something which could be developed for fixed income as well. But yes, the sector exposure, the maximum investment in a single sector does allow you to have a more customized portfolio as we speak. See, the next part of it is that what were we missing in the first place in fixed income? So, what we were missing was that even the credit risk fund in the mutual fund space used to have a criteria. It has a criteria that certain rating threshold has to be maintained. So, you would have to do less than external rating of less of AA and below has to be 65% of 60 to 65% on a AUM basis in a credit risk fund. Now the issuer and it has to be in listed securities, which remains, which I am presuming that the preference to listed debt and preference to rated debt remains as it is for mutual fund schemes. It is the external rating flexibility and the concentration flexibility which improves the ability of making customized portfolios in fixed income also. So that is the first part, the customization. It is diversified and yet focused, because see, in India, credit is very bottom up. You can have very focused sectors, but at the same time, the diversification come from the so in say in all say NBFCs is a very big sector in India, but there are NBFCs which are promoted by some other groups. There are NBFCs which are in a particular product in a particular asset class. So while the sector is the same, there is enough diversification available within this large, say, a group of names, and so it is going to be fairly diversified. It would have the same discipline as mutual fund. I do not, the product filings are still to be done, but if we go by the word of it, it says that something which is not written, it should really follow what the mutual fund is doing. So, which is like only some small amount of unlisted transactions would be allowed there. The flexible transaction window, while some investors will say that, in fixed income, I like the privilege of putting a T+1 redemption, but if you really look at it in this kind of a portfolio, to have the flexibility of allowing only a few days of redemption or weekly or something gives a better maybe outcome in terms of, because the liquidity beyond a few names is limited in India. So if you have weekly redemptions, you can plan the exits in a better way. And it is a slightly exclusive opportunity. Why do I say this is because fixed income portfolios are a lot more institutional today, and they have certain preferences which are taken care for a large set of institutional clients. But in this SIF window, you could do something where investors are aware of what is getting built in the portfolio, and it is not really dictated by large flows which come in and out of other mandates, which in India it has just been historically, which are more institutional. So it is a an in between strategy where you have you have a plethora of mainly category 2 AIFs, and you have the bread and butter mutual fund schemes, and in the middle of this, you have this opportunity as a asset allocation for investors who are seeking through this. So this is actually, as we say, it would still evolve in terms of product filing. It would still evolve in terms of derivatives where fixed income can can do something. So that's still a discussion which we would have in the coming quarters. So yeah, that's about it for fixed income. I think the product filings and the sectors around it would make the offering very distinguished from the existing mutual fund schemes.
Thanks, Mansi. Now I'll hand it over to Niranjan to cover the opportunity in the hybrid side. Over to you, Niranjan.
Thank you. Thanks, Shravan and Aventus team for giving this opportunity. I think so you guys are well ahead in terms of getting this knowledge to your investors. So, congratulations and a great initiative. As far as hybrid SIFs are concerned, let's understand this space. Today, if you see, there are 30, 40 odd lakh investors in debt mutual funds, which are probably earning maybe around 8%, 7.5%, 8% kind of return. But on a post-tax basis, they would be earning somewhere around 5% returns, right? There is another, more than 4, 5 million investors investing in directly into bonds, again, earning 7.5%, 8% return, but paying a lot of tax on it. And especially this change for mutual fund, at least after April 2023, when the taxation for debt mutual fund changed. Similarly, in hybrid mutual funds, as Nandik was mentioning, there are huge number of investors, roughly 1.5 crore investors, with almost 15 lakh crores of AUM, where while they want to take long-term exposure, there could be some investors who wants to enjoy those kind of returns with much lesser risk at times. I think so hybrid strategy within SIF is a beautiful uh, category in which it will give an alternative to a lot of these investors who want to earn maybe 8-9% kind of returns after tax, which is a much more tax efficient compared to a pure debt mutual fund, or maybe bonds or any other revenues that are available in the markets today. So if you can go to next slide. So within hybrids, under SIF, there are two categories that are allowed. One is the active asset allocator long short fund, which essentially is a multi-asset strategy, which allows the fund to invest across equity, debt, REIT InvITs, debt derivatives, commodities and derivatives, and many other asset class. In mutual fund space also, we have a multi-asset fund, but this differs compared to mutual fund, because in mutual fund, the leeway that are there, like it has to have minimum 10% in at least 3 asset class, wherein almost 30-40% of exposure is fixed. The remaining leeway is just 50-60% to maneuver between these asset class. And broadly, if you see the mutual fund space, multi-asset allocation, which are very good, but do not address the dynamism, or they don't maneuver between the asset class dynamically. This category allows this dynamism. One can take maybe complete equity exposure at times, and can go almost 50-60% into debt also. So a lot of flexibility with a wide area of asset class that this category or this specific fund under this category can invest. The second one is hybrid long short, which basically can invest into in a mix of derivatives, equity, and debt, wherein minimum equity is around 25% and debt is 25%. Now, if you see both these categories, the taxation by and large will be either equity, which is 12.5% after a year, long-term capital gain tax, and if it is maybe hybrid long short, where you are not going beyond 65% in equity, you want to reduce risk, it will still be 12.5% after 24 months LTCG tax. So both these categories would address a large area of investors. And as Mansi was also mentioning, the product filings will happen, are yet to happen, but it gives a lot of flexibility for each AMC to run a very unique strategy and playing to their own strength. If you can go to next slide, some of the possible strategies that at least we see at Edelweiss is, if you go with hybrid long short as a category in this bucket, one can have a nice debt plus strategy where you can earn somewhere between debt plus 1 or 2% returns in a much more tax efficient setup, which could be 12.5% after 2 years. It can have, equity arbitrage. It could have credits. It could be a mix of AAA, AA, and single A, good credit papers. Some bit of long short, like covered call, Nandik beautifully explained, various ways you can earn returns without enhancing the risk of your portfolio, and some bit of event arbitrage or special situation. Now, all in all, this kind of product can target a return in the range of 10 to 11%, 10 to 12% after expend post-tax basis. It can be in the 8 to 9% return bucket, with not a very risky portfolio. So the risk or the standard deviation can be targeted to be somewhere between a fixed income product or a conservative hybrid product with maybe 4-5% or less than 4% standard deviation, but with a very stable fixed income plus kind of return profile. When within hybrid long short, one can also run a low risk equity where it is not debt plus but maybe equity minus risk, and the returns could be again in the range of 10, 11, 12% with same equity, covered calls, options, and some bit of credit. And as I mentioned, in dynamic asset allocation can be run as a strategy in the active asset allocator long short. And this is again a category which gives you exposure to right from commodities. One can have ETCDs, one can have equities, REIT and VETs, do long short as well as debt. So again, multiple AMCs will have expertise in one or two areas, and they would like to explore these strategies and run them under a asset allocator strategy, long short strategy as well. So for by and large, for investor, I think so this would be a good category to look at for any alternatives they are looking to a traditional fixed income. While traditional fixed income products will be there in your portfolio, but something which is more tax efficient, something which one can understand based on long short strategies, this could be a category to look forward. I think so I'll stop here, and maybe we can move to the next agenda.
Sure. Thank you, Niranjan. That was very insightful. We'll now open the floor for Q&A. Please type your question in the chat box below. While some questions are coming in, I'll start with few. Shravan, you may answer this. Is this 10 lakh minimum investment limit at the PAN level applicable per AMC or across AMCs collectively?
It's for a particular AMC. You can invest across various strategies. So each AMC can launch one strategy, each in equity, debt, and hybrid. So cumulatively, you can invest 10 lakhs, minimum 10 lakhs in the strategies together in an AMC. But if you're investing across AMCs, then it has to be a minimum 10 lakhs in each AMC.
Mansi, probably you can answer this. Can the strategies like structure credit, venture credit can be part of SIF debt?
See, there is a rating criteria which has come in, which does not say that the rating has to be different from how a mutual fund invests. So when a mutual fund invests in triple till investment grade, then within that investment grade strategy, I can do whatever is allowed as debt instruments. So yes, structured credit can come. So it has to be. So that's what I said, that while product filings and exact situations have to develop, but I would not assume that there would be too much leeway from the unlisted, unrated requirement. So listed debt, I can do, as we said, 20% in AAA and 16% in AA category and 12% in a single A name, plus 5% is allowed with trustee approval. So if you have a single A kind of a name and you want to take a concentrated call, you can do it. So yeah, it is allowed to the extent that it is. I would assume that to the extent that it is listed rated.
Thank you, Mansi. Niranjan, you can take this. In hybrid SIF, can short position be across the asset class or it's only restricted to the equities?
So it can be across asset classes. Like in commodities, you can take a short position via ATCDs. In debt, as Mansi was explaining, there are fewer options, but you can take through interest rate swaps, and in equity through futures, options, covered call. So whatever is allowed under mutual fund today, and all these three avenues are allowed, I think so it can be done at least in these three asset classes.
Will this product make AIF and PMS irrelevant? Who would be better to answer? Shravan, you want to take this?
And I'll give it to Niranjan.
Okay. See, each product will have its own strength. One or 2 points when it comes to taxation, definitely SIF scores over an AIF. But in AIF, which category? If someone is running a long short AIF, definitely the taxation is much more taxing for an investor, because your derivatives is taxed at the business income at the fund level. So all in all, it becomes cumbersome. A similar strategy in SIF, of course, leverage is not allowed, but I'm not sure. I mean, how many people are using leverage in long short Cat 3 AFs? This becomes much more tax efficient. The second point is 10 lakh, right? Many newer strategies for someone to commit 1 crore in a AIF, it can start from 10 lakh, as low as 10 lakh, even 5 lakh if you're investing in two strategies combined. So there also investors can, take that risk and go ahead and at least test the product. So on these two counts, it scores higher. Of course, AIFs, as I said, leverage is allowed. Plus, if you go to Cat 2 AIFs, unlisted and all, that of course we can't do here. But at least Cat 3 AIFs, long short, or even long only strategies, this could be better. Versus PMS, again, the taxation is a big part, because while uh, pass-through is allowed at PMS level, but every churn there is a tax incidence at the investor level in PMS. Here, because they come under 23D, at fund level there is no taxation. Anytime you are churning the portfolio, there is no tax incidence, and it actually allows long-term compounding for investors. So on these counts, actually, it is much more better. Of course, it comes with its own regulatory, I would say, coverage of mutual fund, which is much more transparent, while AIFs and PMS are also on that journey. But when we compare most disclosure norms to mutual fund, I think so mutual fund is much more investor friendly in terms of disclosures and many other regulatory guidelines that we have.
Thanks, Ranjan. The another question is, how much alpha can these new strategies generate over conventional MF? So I'll go one by one. So I'll start with Nandik. So yeah, what kind of alpha can be generated on the SIF equity space? Your voice, Nandik, your voice is here.
Hi.
Yeah.
No, I think it's a bit. I would not be commenting on the quantum of I'm expecting out of this
Nandik, your
category.
voice is not audible,
But
at least to me.
Yeah, it's not clear. Nandik, try again, please.
Yeah, is it better now?
Yes, yes.
Yeah, it is. Yeah.
No, so I don't think it's correct on my part at this stage to be commenting on an absolute number what can be delivered over, let's say, other funds available in the market. But just from the sense of it, because more scientific hedging is allowed in this, some decent amount of alpha should be generated vis-a-vis the hybrid funds. And then so I think that is what I would want to stay at this stage.
Mansi?
So see, alpha in fixed income comes from so last year, if I see this is the year gone by, one of the best performing category was the long GSEC. And there is no differentiation whether you're doing it in a mutual fund or you would have done it in a SIF. You could have just done it, any situation. But yes, so where the alpha would come in probably would be very dependent upon the kind of, as I said, the little bit of concentration and a little bit of ease of taking some bit of illiquidity or something that can come in. So that is where I guess pure fixed income would come in. But yeah, the hybrid has a lot of space, and Niranjan has explained already further. The alpha comes there that when you do a mix of debt in a more hybrid or a more the 2-year LTCG platform, there you see a significant kind of a benefit maybe coming in vis-a-vis a pure concentrated debt or debt long short strategy.
Niranjan, want to comment something on this?
Yeah, I think so. It's see, too early also. It depends what is the objective. As I said, in each category, one can define what objective the fund wants to achieve. Is it absolute alpha, or is it, a better risk-adjusted outcome? Maybe a lower risk, but a debt plus kind of return. So every strategy objective could be different here. But as Nandik was mentioning, allowing synthetic, derivatives, covered calls and all with a lot of leeway compared to mutual fund. I think so it'll be quite interesting to see how many people want to generate absolute alpha over pure equity, or how many people want to generate a better risk adjusted return and design a product which is suitable for a fixed income investors in a much more tax efficient. So I think so the objectives would be different, and investors need to see what objective they want to meet in their portfolio with SIFs.
I'll come in here. I think through the AIF industry, especially in the case of long short funds, which were equity oriented, we have seen returns getting generated. It's just that the taxation was such severe, that the return profile used to be sub, let's say, ETF profile. But if you have the taxation into consideration, which is favorable in this case, I'm assuming that it's going to be at least about 150 to 200 basis points alpha over it. And second point is it's all about execution, right? At the ground level, you need to sit and do this work every day, day in and day out, and make sure that you are capturing the strategies. And I think some of the talent that we have seen in the industry in the AIF side can actually do a tremendous job of it and producing more alpha. So I think it's very clear, at least in my mind, that equity can actually offer a lot of alpha to the investors and protecting actually risk. Fixed income, it's where the strategy has to be defined, understood, and implemented, because remember, there is a weekly exit that you need to provide. You don't want to be locked in by having a credit profile in the fund when there is a weekly liquidity. So that part is unclear, but equity, I think, there's a lot of value on the table.
Sure. Thanks, Shravan. Maybe one more question to Shravan. Just to understand, would that these fund would have a regular and direct plan also?
Too early to comment. I don't know about it. Considering that still the filing is, I think, in progress. I think we'll just wait for the filing to happen and see whether there are direct, regular, what kinds of plans that are there.
Yeah. Can SIF would also have lock-in products? Niranjan, probably you can answer this.
So yes, lock-in is allowed. The circular says, both close-ended, open-ended, even interval is allowed. And it is up to AMC to design a product, whether they want to go for a close-ended or interval. So everything is allowed. I think so. Broadly looking at the strategies that are allowed, more AMCs would prefer to give an interval kind of option, because even in equity or hybrid, you can, increase the redemption and subscription frequency to maybe monthly, quarterly also. And I think so that takes care of liquidity and many other problems which a pure open-ended may have. So we will see more of interval structures, in my view.
And also, again, Niranjan, you can answer, is that again, being an open-ended to close-ended, there would be similar structure like SIP, STPs, SWP, which we have in mutual fund format. Would that be
absolutely
for SIP?
So all features, specifically SIP, STP, would be allowed. The only condition is if you're doing an SIP, the minimum threshold of 10 lakh needs to be met first with lump sum investment. And after that, you can start an SIP. Depending on AMC limits, what they want to keep. If someone keeps a 10,000 SIP, one can do a 10,000 rupees SIP once they complete the 10 lakh threshold.
Shravan, maybe this one was for you. What should investor evaluate before allocating capital to SIF?
No, I think the fundamentals of manager selection and strategy selection remains the same. right? What kind of team is managing that? What is the past experience? What is the strategy that we are investing into? What is the return profile? What is the risk profile? Drawdowns, volatility, all these kind of things which we normally see for a manager. And thankfully, we have had the experience of evaluating in the AF space. I think the same I think application can be happening here also, right? Especially with derivatives involved, you would have to be a little careful about what is the risk that you're taking. Thankfully, SEBI has also, guided for the AMCs to disclose a format, in which they can talk about, how much is the maximum loss that the fund can go through, etc. So this coverage, which I think Niranjan spoke about, I think is a good thing. So at least the risk part of it is taken care of by the platform that is offering. There are risk bands which the products have to publish every month. So that also, is a guiding post. So I think all the fundamentals of what we do for normal mutual fund AIF selection applies in AIFs as well.
I think a lot of question again as for us, has been asked for the taxation. Nilanjan, can you kind of, just revisit the different asset class would have a similar taxation?
Sure. See, today, one thing is very clear, and Shravan beautifully explained this, that, and even Nandik explained this, that it will be under a mutual fund bar. So, fund level taxation, there is no taxation at all as mutual fund. Now, at the investor level, when they redeem, only that is when the tax incidence takes place. Now, over there, it will depend on how the product structure is done. There are only essentially three ways this fund can be taxed. One is if the equity exposure is above 65%, it will be taxed as per equity mutual fund or equity taxation, which is LTCG 12.5% after 1 year. The second bucket would be if it is completely debt, which is most credit strategies and all will be there. More than 65% into debt instruments, it becomes a specified mutual fund as defined in the recent last budget. So there the taxation will be MMR, which is maximum marginal tax rate. And the third is any other asset class for which the taxation today is 24 months. After 24 months, LTCG is 12.5%. Now, all strategies that that are neither equity, which is more than 65%, or neither debt, which is more than 65 or 65%, more than 65% debt, will fall under this. So if someone is running a hybrid equity with 25% equity, some bit of arbitrage remaining in debt, it will be taxed at 12.5% after 24 months. So there are only three tax structure. One just needs to see what is the percentage of debt, equity. If both are below 65%, then the third bucket, which is 2 years, 12.5% applies.
Thank you. Nandik, this is for you. Do SIF increase return potential for investors at same risk or same return for the lower risk?
So interesting, there's a third option available, which is higher returns at lower risk. So the way I see it is the returns will only improve compared to, let me not quote a number, the returns will be higher than the standard hybrid funds which you have in the industry, and the risk profile will be lower because a lot of scientific hedging is allowed. One important point which we have to consider from an AMC perspective is SEBI has given us three categories, but under each category they have given limited number of funds you can launch. So under equity, you have three subcategories. Under debt, you have two. Under hybrid, you have two. In each subcategory, an AMC may launch only one fund. So the maximum funds which an AMC can launch as of now is seven. So from a strategy perspective, it becomes very important. This is not for investors, but from the AMC side, to be very careful and choosy about what funds they want to launch. If let's say you launch seven funds on day one or day zero, then basically you're exhausting the entire gunpowder which you have. So from that perspective, at least our house, we will be a bit careful, and maybe on day one or day zero, we launch only two or three funds in the market to start off with, then see how the industry evolves. But I'm very certain that the returns will improve and the risk will also come down. in the hybrid segment.
And then one question here for you. In the second type of fund in equity, you can invest into X100 stock, which is probably mid and small cap stocks. You can also short that particular segment, right? You can't short large cap segment. Is there volume in the mid and small cap segment to short?
No, there is not a volume enough in the mid and small cap segment to short. You can do it via the index derivatives that they have, the mid cap index that they have. With that, you can take short positions. But I'm not very sure that you cannot short, let's say, a Nifty or a Bank Nifty or Bank Nifty index futures or options in that. I think even that scenario is open. So, if you were to do this strategy, there will be some amount of correlation or mismatch risk between the top non-top 100 names and the index that you choose.
Got it. And Mansi, do you think this is an opportunity to expand the derivatives market in debt?
So yet it is an opportunity, but for expanding the derivative market in that, so the interest rate derivative market is fairly okay. There is not that there is no opportunity to do there. Let me just point out there's a small kink in it which says exchange traded, and actually interest rate derivatives in India are not typically exchange, but they are on a CCIL platform. So I would assume that that is good enough for this purpose. And there, the interest rate derivative market is quite well placed. The credit derivative market is very, very fledgling. And there you need a lot of participants to come in to give you the contra view as well. So, I mean, it's an opportunity, but it is to be seen that how you're going to be able to do derivatives, the credit derivatives of any other derivatives there.
And the second option in debt, when they call out 25% short position, that is in
Yeah.
a particular sector, is what it's called out.
It is actually quite, yeah, that is something which we are debating, that how do you take a sector short in fixed income? There are hardly any players or there are hardly any instruments available to take that. I don't, and it is very, and on top of it, fixed income is quite bottom up. So you would not be able to short a particular, even if, just for the sake of giving example, I would say that a sector is not looking good. But in India, the bottom up, that who's the promoter, what is the kind of facilities they have, what is this, it's a secured debt, it is structured in a way, does not make it a short. So yeah, these are issues that we would do when we are thinking of products in the space. Is there a sector short that can actually be played? So that in itself, I would err on the side of caution and say that that particular fund where you want to do a sector short is not looking very feasible today.
Got it. Niranjan, this question is for you. Who do you think will be the first to launch and when?
Say Edelweiss. And since Nandik is here, maybe Nandik and Mansi as well.
Great, great. Because I think there's a requirement to go through a exam, for
Yes.
distributors as well, right? So we
On
also
the
have to-
distribution side as well as on the AMC side. Plus, there are a couple of things which we are awaiting from SEBI, like, the application form to apply for this as a license and, SID format and all. I believe over the next week or so, a few days, most of these things will be cleared off.
Got it. Paima?
Yeah. I think most of them have been answered. So we'll conclude the call. Thank you. Thank you all for your active participation. We hope you find this session insightful. We look forward to see you in our next edition. Have a good evening. Thank you all.
Thank you. Thank you.
Thanks, everyone. Thank you.
Thank you.